Today with us, Mr. Aashish Somaiyaa, the CEO of WhiteOak Capital and Mutual Fund. It has been fortunate that we got Mr. Somaiyaa to discuss about a lot of things, including how he's feeling about the economy and what are the fund managements are going to work. Mr. Somaiyaa has been a stalwart in the industry through his Motilal Oswal days. If most of the industry veteran knows him since his ICICI and Motilal days, he has been the turnaround person who actually helped Motilal Oswal to form a 1300 crore fund house to take it to 40 to 43,000 crore fund house. Today he has given us the time to discuss about WhiteOak thing because he has been the CEO of WhiteOak now. Thank you, sir, for giving us this interview and the podcast.
Thank you. Thanks for inviting me. My pleasure.
Sir, I know that you have been from the Motilal days and all those things. Everybody in the industry knows about you. Can you slightly brief about yourself and why did you, because in ICICI you have been a comfortable job, why did you take this risk of going into a 1300 crore fund house and start the journey? Probably it would not have gone the way you have thought it. Today, when you look back, you have always been a wiser and say, yes, it has gone really well. And actually, it gives you a special name in the industry. But what was your psychology at that point of time? Almost going to a startup from an established brand of ICICI.
So, I would say that, I was fortunate. The reason being that what you do later comes later. The point is that when you are presented with any opportunity, that itself is that you're lucky that you get some opportunities in your career or, in the industry that you're working in. Now, I've always believed, if you really ask me, so the point in time you're talking to me, say, about something which I took up, say, 10, 11 years back. We're talking about, say, 2012. Now, whether it's 2012 or whether it's now in 2023, one thing that has underlying always been a conviction that as far as our industry is concerned, it's very closely linked to India's economic evolution. And India's economic evolution has also closely tracked the evolution of India's financial markets, and digitization and the demography has played a huge role in it. So, as convinced as I am right now that we are in a tailwinded industry and that capital markets are bound to grow, and the best way to participate in capital markets is mutual funds. So that kind of surety was always there. And to be honest, in 2012 when I got that opportunity, frankly speaking, I worked in ICICI over 2 stints, but totally almost 12 years. I think by then I was ready to take up a larger challenge. And probably at that point in time, the challenge was even more alluring because when I took up an assignment to lead an asset management company, that time in India, there was an exodus of asset management companies because, 2008, 9 till 11, 12 was very, very tough scenario. The industry didn't really grow. If you look at 20, 30 years, there was massive growth. But those 3-4 years, there was hardly any growth. Markets were very challenging.
Most of the international AMCs left.
They all exited. The biggest of names, not naming here, but the biggest of names, you name it, and they all exited. By 2013, India was known as one of the fragile 5 economies. But what happens is that whenever you're building a business, the most exciting part about building a business is that you're hypothesizing about the landscape. You have some view or some vision. Okay, this is how the industry landscape is. This is how it will evolve. These are the white spaces, or these are the areas where, there is slight opening in the door, where we can go in. And, those openings or those areas where you think there are opportunities, you need to be able to match that with the competencies of the organization that you are trying to build on, right? So I think that at that point in time, we were able to build a specialized, asset management company specialized into equity management. And, right through portfolio management services, highly differentiated mutual fund schemes, and then, of course, a highly differentiated slew of passive products. Right? In my previous role, when I used to work for Motilal Oswal, we were amongst the first ones to create S&P 500 fund or NASDAQ fund and a series of others.
Yes.
Like today, for example, in the industry, there is an entire category called focused funds. The first ever focused fund, which was created back then, was created by Motilal Oswal. First fund house to start talking very sharply about a defined investment philosophy and codify it in their brand statement. That also was the first one. I think now everybody talks about investment philosophy, but I think 12 years back, people were only buying products and performance. Nobody was talking about philosophy. So a very exciting journey. And, I think for any professional CEO, building an organization, putting the right talent, like I said, hypothesizing about the business landscape. These are always the more exciting parts.
But sir, when you were actually build the Motilal Oswal from 1300 to 42,000 crore, why did you take another same kind of journey with WhiteOak? Because we have seen that most of the people who once get into the comfort zone of building the business and everything, they don't like to get out of it.
Sure.
Because they have already built a team with themselves and all those things are already in place. So taking another stride towards a company which is new to the mutual fund, the mutual fund space is now overlapping. A lot of companies are now coming into mutual funds. Why did you take that journey again? Is it only that you have the confidence that I did it before so I can do it again? Or is it building something exceptional rather than the traditional mutual funds?
Yeah, so the thing is that there are 2 or 3 aspects to it. One is that, say, I've been in the industry since 1999. And broadly speaking, if you see, I have had 2 stints. The longest one was in ICICI Mutual Fund for about 12 years, and then 8 years with Motilal Oswal. And I've been CEO for WhiteOak for about 3 years now. You can imagine that I'm not somebody who's changed many roles, really speaking, broadly worked in 2 organizations. And in our industry, I think working long in an organization is a must. And, before you pick up any assignment, you should be absolutely convinced that you will be able to work for the next 10 years, 15 years. I'm not a portfolio manager myself, but for a fact that when we build products and when we have portfolio managers, the first thing you as a wealth manager will look for is the length of track record of that portfolio manager. So while I'm not a portfolio manager, I'm sure even for a business leader, that is something which is important that, you're building an organization, if you're getting people, if you're launching products, how long are you going to hold hands with the entire stakeholders? So the first thing was, when I spoke to Prashant, Mr. Prashant Khemka, he's the founder of WhiteOak. He founded the firm in 2017. And I interacted with him in 2020. Prashant is actually a very unique kind of person because I don't know how many people know, but when WhiteOak got asset management license, probably the first time that a professional manager got a license. Otherwise, if you see in our industry, the history is that all asset management companies are either from a bank or insurance company or a broker or a fintech nowadays. Yeah. In case of WhiteOak, it's probably the first time that a professional fund manager got a license. So before founding WhiteOak, he's not part of some conglomerate. He's an individual who was chief investment officer for Goldman Sachs Asset Management, managed money in US, managed money in India, and he was also their CIO for global emerging markets. He had already set up like a team of investment professionals. Then I was reached out or I was recruited to help him set up the domestic business because lesser known fact is that, say, WhiteOak manages $7 billion. It's amongst the largest single country FIs in India. We manage more than $5 billion for global investors. Because of Prashant's background in Goldman Sachs, he had a sense of, he knew that he would build a global business. For domestic business, he needed professionals to set it up. So from my perspective, so this was the background. I think Prashant has very high credibility, very high competence, and not only him, he has built we have the largest management and research team amongst any asset management. A young company to have more than 40 people in fund management. And back then also it was 15 and now we have scaled in the last 3 years. So the competence of the founder, the team that was built, I think that was alluring for me. Second, I always knew that, the number of asset management companies in India, even now, when there are more than 45, I think there will be 100. In fact, I think there is unending potential. Right? So I was always certain that there will be scope to, more asset management companies will come and there is scope to create, a whole setup. The third is if I see my personal preference, so, if you look at it this way, it takes different acumen to manage something which has been scaled already. And it takes very different acumen to build something from scratch. So personally, if you ask me, I always find it more exciting to build something, to get a team, to set up a team, create products, create brand, to create marketing strategies, create communication, build a performance track record. I think building from scratch has different excitement. Right? And like you said, if you have done something once, then you would definitely like to
the fear
see
factor
for yourself. No, in fact, the fear factor is there, but you would definitely like to see for yourself whether when you are building a business the first time, is it just that there was a confluence of factors and partly you got lucky, or is it that there is some competence that you have? For a professional CEO, it's always exciting to set up something.
Yes. So, if I talk about WhiteOak has been phenomenally well in AIF and PMS. So, we have seen, you can say, the reverse driving.
Right.
Usually, we have seen that people set up the AMC, and when they need the extra money or try to favor the clients who have a lot of money and all those things, they go into the PMS and AIF part. Where in the WhiteOak, we have seen the reverse mechanism. They have been well into PMS and AIF, but they have now come to the retail part. So what was the logic behind it, and why they could easily have done it with, because when a PMS and AIF, the definitely the fees are much higher, the profitability are much higher, but AMCs, the profitabilities are much lower, and there is no point because to come into the retail segment, because retail is difficult to cater. So what was the logic, sir?
I'll answer this, and Shoma, you may or may not have noticed that it has gone reverse on two aspects. One, you mentioned that first we did alternate investment funds and PMS for high net worth investors and private bankers like yourself. Then we started going into retail, which is mutual fund. So I think you're right, because typically mutual fund companies try to set up PMS and AIF. Whereas here, what you're rightly pointing out is that we have gone reverse. That there is another way in which we have gone reverse, which also I'll explain to you. Typically, companies which have large retail brands and large distribution, then they try to start saying that, okay, we have a retail presence, let me also reach out to institutions. But even on that, WhiteOak progression has been slightly reversed. So let me just explain. Originally, in 2017, the early days, WhiteOak first started managing money for global investors. The global investors for whom we manage money are the largest of the large institutions, like their sovereign wealth funds, pension funds, university endowments, there are very large family offices. In fact, WhiteOak as a group first set up its mutual fund in Europe, where, mainland Europe, Middle East, Switzerland, UK, all of those investors. Then Mauritius, there is a fund which is listed on London Stock Exchange. So originally, WhiteOak started more as an institutional manager for Indian equities. And from institutional, because of PMS and AIF, we started reaching out to private bankers, wealth managers, and high net worth investors. Then we have moved into retail, where we become so institutional to HNI to retail. And that's how the progression of products has also happened, which is managing institutional mandates, then managing HNI platforms, then managing mutual funds. So that is how the progression has been. And I'll borrow on what our founder Prashant actually says. We don't look at it from a profitability perspective at all. Best way to look at it is that, any passionate cricketer will play T20 also, one day also, and test matches also.
Yes.
So any passionate sportsman will try to play in all formats. And if you're somebody who can cater to all clients and manage money on all types of formats, right from managing an institutional mandate where the institution tells you what outcomes are desired, right up to managing money for retail investors where they don't tell you, but you are just basically supposed to beat the benchmark as consistently as possible. So I think the belief is be able to manage money for all formats and use our competency to create wealth, grow the assets for all types of investors.
Sir, right now there are almost 50 AMCs. Yeah. How do you want to create niche for WhiteOak? What is your plan for creating that niche? Because if I have a multi-cap, or if I have a mid-cap, or if I have a large cap, so I am playing with only that 100 stocks or 150 stocks. I cannot go, as per SEBI guidelines, we cannot go beyond it. So how are you creating the niche?
So see, 3 or 4 things, Shoma, you may have seen that for WhiteOak Capital, I don't know, maybe a lot of people may not have, because we are still establishing our presence. Right now, we are building our product range. We're building our presence with distribution. So we don't advertise really speaking. So many people may not have noticed. But for WhiteOak Capital, our brand line or the tagline is the art and science of investing. We don't promote it and we don't talk about it, but therein lies the entire essence of your question. 2-3 examples I'll tell you. One is, if you really look at it in our industry, equity fund management is a lot riddled with folklore. Even the normal person, lay person must have got some message saying that XYZ person bought this stock and it became a multi-bagger. That is their claim to fame. You may have got that 10,000 rupees worth of Wipro. If you bought it, would become 500-600.
Yeah.
See, all these things don't happen to laymen or to lay people. All these things don't happen to the average investor. For the average investor, just about beating benchmark is what they can strive for and what they can aim for. Let me tell you that when you are managing money to beat the benchmark, fund management is made out to be only about stock picking. Let me tell you, fund management is not just stock picking. Beat the benchmark, you need portfolio construction. A lot of times stock picking and valuation is made out to be an art. Or at least stock picking is made out to be an art. But let me tell you, valuations, portfolio construction to beat the benchmark, all of that is science. And in that sense, WhiteOak as a team or as a bunch of professionals is a very good balance of left brain and right brain. We don't try to say that this is all about art, that, look what multi-baggers we bought. We are basically constructing portfolios to beat the bench. If you take WhiteOak as an institution since its existence in last 6 years, or if you take Prashant and our colleagues earlier in their sprint, they have a long history of having beaten the broad benchmark by convincing margins. Even now, if you see our long-term track record for AIF, DPMS and the mutual funds, in each and every product we manage, we are significantly ahead of benchmark. Yes, of course, it doesn't happen every quarter, every year.
That is not possible.
If you take a reasonable time frame, we are everywhere we are ahead of it. So that is one. If you in our industry now, while there are many players, the good part is that if you deliver performance and if there is a perception that you have the competency to deliver performance, you are able to create your position.
Yes.
Second thing is that to enable this, WhiteOak has the largest fund management team in the country. We have over 41 people in fund management and research. We manage money in global emerging markets also. So for a moment, if I exclude our dealing teams and trading teams and the emerging market team, just look at India. We have more than 30 analysts covering 650 to 700 companies. To give you sense of scale, the biggest of institutional brokers, which serves so many AMCs and institutions, they might be having 30-35 guys covering 300 companies. For our own, if you see for our captive fund management, we have more than 30 people covering 650 companies. So it's not just about large, mid and small. We are going all the way up to 650, 700 companies, which means we are covering companies with 1500 crore, 2000 crore or even 1200 crore market cap, entering them at early stage. These are the kind of things, which helps to generate alpha. The third thing is that you see, we are not owned by some bank or broker or institution. We are not here because we have good distribution strength or because we have offices all over the country. We are here because we think we can deliver.
Yes.
Right? So I think it is our market is quite very, very meritocratic, and digitization has made it very, very democratic also. I think we are quite confident that we'll be able to differentiate ourselves if we are able to generate performance, if we are able to communicate clearly. And as we go along, you will find that WhiteOak will be the first Indian company which will be truly a multinational asset management company. There are not many asset management companies of Indian origin which manage so much of global capital. There are no asset management companies of Indian origin which manage global emerging markets. So in many fields, you see Indian companies which are MNCs. I think asset management, the first Indian MNC probably will be WhiteOak.
So right now, if we look at the global economy, US interest rate is lifetime high, and India's also cost of capital is increasing. US recent Fed meeting, they said that we are not ruling out the recession as of now. Yes. There may be a possibility of recession.
Yeah.
India remains a bright spot in this entire journey. How do you see, sir, global economy in the context to Indian economy at this point of time, sir? What would be your advice to the investors on that?
See, I think what happens is that a lot of investors get very, very preoccupied with studying what is happening in US. So much so that a lot of us stay awake at 2 a.m. to see what the Fed policy is saying, etc. The reality is that we are counter-cyclical, right? So see what has happened right through 2022 and some part of 2023 when the Fed was raising rates. So what happens, obviously, when the Fed is raising rates, the dollar becomes strong. The dollar becomes strong, that puts pressure on the rupee, and that puts upward pressure on our interest rates also, right? Yeah. Now, if the US economy slows down, it would impact US equity markets. It would create some sentimental impact on Indian equity as well as global equity markets. But let me tell you that if the US gets into a slowdown, and if their stock market starts to suffer, initially we might get a knock-on effect, but with some lag, we'll actually start to outperform quite significantly. The reason is because that if you purely see from a economic standpoint, economic cycle standpoint, we are counter-cyclical to them, right? Because they are coming into a slowdown from a period of unbridled expansion post-Lehman till 2023. Yes. unbridled expansion. COVID was a 45-day blip for them. So they have gone through unbridled expansion for 12 to 13 years. Whereas we actually, before COVID hit us, our FY20 GDP growth was only 3.7%. So before COVID came, our biggest problem was that the world was booming and we were struggling. So we were not able to have we were not able to prime our economy. We had to maintain a tight fiscal and monetary policy because external environment was booming and we were down in the dumps. COVID came, actually, it's a human catastrophe, but it came as a relief. Because of COVID, everybody went to zero interest rate and high liquidity. That kind of let us off the hook. It gave us much needed reprieve, and we were also able to prime our economy eventually. So now the net effect is that we are counter-cyclical to the US. So if the US slumps, what will happen is that the dollar will give up its strength. If dollar gives up its strength, then rupee would be relatively stable. And my experience tells me there is an avalanche of FII flow waiting to come into India. If the dollar is strong and the rupee has a depreciating bias, all those guys are going to hold back.
Yes.
But the moment dollar gives up its strength, you will find inflows of unprecedented scale.
Even, sir, we have seen that though dollar has become stronger, but it is not that strong against other currencies compared to India.
Yes.
Because otherwise I thought that we could have touched 100. But yes, because one of my very close relative who is a director in Charles Schwab in US. Okay. So he also told the same thing, that India is much more stable.
So I would just build up further on what your relative mentioned. Our experience is actually that there is unprecedented interest for people to start looking at India. Also, let's not forget that in India previously, bulk of the money, like almost 80-85% of the money which came into India, didn't deliberately or directly come into India. It ended up coming indirectly as a part of some global equity, global emerging market, Asian equity, BRICS, those kinds of things.
Yes.
But now what has happened is global emerging markets in last 5-10 years as a basket has disappointed. Practically everything has disappointed. India has stood out. Even China, their economic gains are not reflecting in the stock market gains.
No, not at all.
Right? Because for economic gains to translate into stock market gains, you need institutions, you need rule of law, you need, regulation, you need the whole thing, apparatus. India is one of the few markets where economic gain has directly translated into stock market. So what we are witnessing is not just interest in India, but you will also find that instead of money coming through some basket like global equity, global emerging market, you will see more money directly coming to India as a single country.
Yes.
More deliberate exposure. That actually gives more stability and longevity.
Sir, we have recently witnessed a massive growth in mid and small cap segment. And I have recently did some interview with fund managers. So some said, yes, we are still bullish about the mid and small at this point of time even, because small cap is almost 22% high from even the last record high, previous peak.
Yeah.
And but some says, yes, we are cautious. What is your take on that thing, sir? Especially in mid and small.
Sure. I think it's also a function of relative performance. See, look at it this way. Just, in previous segment of our conversation, we were mentioning, we spoke about US policy, we spoke about US dollar, the headwind for Indian currency and markets. As a result of that, barring some spot of April, May or March 2023, barring that spot, FII flow is now negative for nearly 2.5 years?
2.5.
From July 2021 till now, barring couple of blips in the middle, it's consistently negative. That is one data point to remember. And like I mentioned, and like you also corroborated, there is reason to believe that will eventually change if the dollar gives up its strength. That is one data point to keep in mind. Second thing, let's say we are chatting in November 2023, and I distinctly remember that at this point in time, if you take last 1 year point-to-point data, what you will find is that 100 rupees invested in Nifty 100, which is large cap index, 100 rupees invested in the large cap index is only 109, whereas 100 rupees invested in the small cap index is 140 today. Right? So, 2-3 things to keep in mind. You're in a landscape where 2 to 2.5 years there is FII selling. Second, you're in a landscape where in last 1 year, small cap has beaten large cap and the broad market BSE 500 by a very wide margin.
Very wide margin.
So now the point is like this, you and me can keep discussing that whether small cap is attractive or not. And let's say for a moment we conclude that it has gone up a lot, it is still attractive. That's not how the market functions. The market There are enough number of intelligent people in the market who will see that there is a stark difference in relative valuations. Why 1 year? You see the entire 2 years, Nifty is continuously loitering around 18.5 to 19.5. It goes up or down sometime, but consistently 18.5 to 19.5. Now, third data point. What is the biggest discussion or debate in the market, generally speaking? That the big banks, like say for example HDFC, the big banks have not delivered any return in the last 2-3 years.
No,
correct?
Kotak has not.
Yeah. So none of the big banks. You corroborate all of this, what you will realize is that generally when there is wide domestic participation, there is a penchant for buying cyclicals, PSUs, small cap, mid cap. Whereas the high beta or the cyclical part of the market is what retail investors tend to, generally domestic investors tend to buy. And what do foreigners tend to buy? ESG consciousness, longevity, sustainability, blue chip, high governance, big free float, large cap. So now you can piece the whole picture together, and probably I would stick my neck out to say that in the next 6 to 12 months, let's say election is behind us and we get continuity. So all of this picture, if you piece together, you'll find that next 6 to 12 months, in my humble opinion, large cap is primed to outperform. Any which way, we don't construct portfolios thinking one will outperform, other will underperform, because we are concerned with generating alpha. Purely on this discussion about market caps, market will always look at relative movement and also the flows and what type of flow is coming. It will also determine. My sense is that you should not completely discount the large caps or start thinking that everything in small cap will work. I think there is a lot of potential for market to rotate.
And readjust its position.
It will readjust, whether it is sector or market cap, it will rotate.
So in WhiteOak, sir, do you follow the top-down approach or bottom-up approach? Which one you mostly follow?
So, we are strictly bottom-up investors. Strictly bottom-up investors. But what happens is that ultimately we are managing to beat the benchmark. So a lot of time what happens, people who are purely bottom-up, they put variety of filters and screeners saying that I'll only buy businesses which are more than 15% EPS growth, more than 15% ROE, cash flow growth, these kind of things. We are not the kind of guys who put filters and screeners. Our filter and screener is simple. Everything over 1,000 crore market cap is our universe. So over 1,000 crore market cap, there are more than 900 companies. Then you will say, okay, I want promoters who have good track record of respecting minority shareholder. Other than governance, there is no filter. Let's say you are acceptable governance, say you are 700 companies, 650, 700. Those 650, 700 also will not take at face value. Then we grade it as 1, 2, 3, 4, 5. So one is in the portfolio, who is meeting our parameters, but valuation is expensive. 3 is something which we are covering and waiting for some hypothesis to evolve, and so on and so forth. 5 is something which we will not. So we start with the entire universe. The only filter we'll apply is governance, right? And then we will have a team of more than 30 people who are updating valuation models, understanding, conference analyst calls, doing scuttlebutt, because everybody's mapped 20, 30 companies, so they are doing their work. Like say by banking and financial services, we have 6 guys covering 108 companies. For every sector, there is a bunch of 4, 5, 6 people. There is a sector leader. There are 4, 5 people reporting to the sector leader. They all contribute to building portfolios. So what happens is we are completely bottom up. Only thing is that we are managing money to beat the benchmark, which means we will be benchmark aware. So we will not impose top-down constraints, but benchmark is something to respect. Correct? So if the benchmark has 30% in financials, I don't want to be 10 or 60.
Yes.
Correct? I don't want to beat the benchmark by taking exaggerated calls that this sector will do well. No. We want to beat the benchmark purely through stock picking. So if the benchmark has certain allocation to sectors, we will respect that and we will have some semblance of reflection of that in our portfolio. That should inform our portfolio in some way. Similarly, if you see the benchmark has domestic companies, export companies, defensive companies, cyclical companies. Benchmark has private sector companies, state-owned companies. Now, what we will do is that we'll ensure that our portfolio has some tethering or some portfolio should be informed by benchmark, but not necessarily benchmark hugging. Answer in brief, we are purely bottom up, but we are benchmark aware because we have to beat the benchmark.
You have launched multi-asset fund.
Sure.
And capital builder fund.
Multi-asset, yeah.
Yeah. So can you explain to the clients, investors, what exactly the multi-asset and capital builder fund and how they're going to get benefited by investing into them. The launching time that multi-asset fund was because that you are expecting there is some correction in the market or having the exposure in debt. So is this the logic why when you launch the fund, or it is purely as a fund perspective? And
so, if you really ask me, strictly speaking, see, multi-asset allocation fund, like this is something which I'm very passionate about, because personally, if you ask me, asset allocation is like a chemistry.
Yes.
Right? Because in a multi-asset allocation, what are you trying to do? We invest in domestic equity, international equity, fixed income, and gold. And by arriving at a combination of all these asset classes, what you're trying to do is you're trying to get returns from every stream of asset class. At the same time, why I mentioned chemistry is because when you combine these asset classes, they should be an uncorrelated bunch of asset classes. So you are trying to use each of these asset classes return profiles or the variability of returns. You're using it to dampen the volatility of the end product.
Yes.
So the volatility should get dampened, whereas the return at different points in time, different asset classes should provide you the return. But at the same time, their volatility, when it merged together, it will get dampened. To give an example, we launched multi-asset allocation fund 6 months back. 6 months is not something great to go by, but let me tell you the experience so far. In 6 months, it has generated about 6% return. But it's not the return which I am thrilled about. What we are most thrilled about is, if you take the daily NAV movement of the fund, the volatility of the fund is less than the volatility of domestic equity, less than the volatility of international equity, less than the volatility of a typical bond portfolio, and also less than that of gold. So the biggest proof that we have done asset allocation and combined the asset classes appropriately, the biggest proof is that we are getting a return, but volatility is lesser than any of the individual asset classes. So it was created, why we created this kind of product. It is meant, we are aiming for a high single digit kind of performance with low volatility, right? Why to create such a product? Reason is very simple, that if you see in the last 3 years, for people who are fixed income investors, there is a series of debacles. 3 years back, there was a credit issue. Last 2 years, people haven't made money because interest rates have been rising. And then earlier in 2023, when the budget came, fixed income funds lost their tax shelter also. Now, the way we are creating this fund, it is currently 26% equity, 23% gold, 8 or 9% global equity, and the rest in short-term debt. So you can imagine that, when you have equity, you want to dampen the volatility of equity, you need to have corresponding ability to buy gold.
Yes.
And the level of each asset class, it should be unfettered. They should be allowed to find their own level depending on relative performance. And, the way we have constructed it, if you hold it for 3 years, it becomes a long-term capital asset. So I think it's an ideal combination for people who don't have options to put money in longer-term debt. Then what will they do? That's why we created a hybrid.
Okay. Sir, now take a cue from it. I have seen that WhiteOak has not come with much of a debt kind of a products, as well as international products.
Right.
Because you have a expertise in international funds, because WhiteOak is managing all over the globe. So any intention that you would be coming into international products, because suppose like China, or probably in NASDAQ, or probably in Europe based. Long back, HSBC was having a fund called Brazil.
Latin America.
But I do not know how it has actually worked out from them. I think it did not much work out from them. But because you have an international expertise where most of the fund houses based in India do not have that kind of expertise, plus debt, which is another thing. So do you have any plan to come up with this?
So see, when it comes to debt, look at it this way, that we created a debt alternative through multi-asset allocation. And we have, we have very competent fixed income managers. Piyush Baranwal, who's part of our team, he is a highly experienced fixed income manager. Only thing is that since the time we started launching our products, interest rates have only gone up and up. I'm not into forecasting interest rates, but it's not an ideal environment to start creating a suite of fixed income products. Second is that we do manage liquid fund, ultra short-term fund, which has reasonable performance. Plus, in all our hybrid products, there is a sizable fixed income component. So we are serious about fixed income. Only thing is that how do we tackle the needs of investors and what environment we are operating in? That is what determines how we will face our activity. Coming to international funds or global funds, in fact, it's a lesser known fact. When we filed our first fund, which is FlexiCap fund, we actually filed for a feeder for global emerging markets because WhiteOak outside India, within our group, we have an asset management company in Singapore. We already manage our global equity fund and we manage global emerging markets. As you will be informed, currently in India, the Reserve Bank imposes a limit on how much the mutual fund industry can send money outside for investment.
Yes.
So we are held up because of that. The moment there is any relaxation of international investment limits, I'm quite certain we'll be the first one to queue up and file for global emerging markets, global equity. In fact, we are the only fund house globally which has, for Indians, we have a global emerging market fund ex-India. Because as you'll appreciate, in every global emerging markets fund, India is nearly 20%.
Yes.
If you're an Indian investor, you're already overexposed to India.
Yes. Yes.
Right. So we deliberately created an offering which is global emerging markets ex-India. So we are absolutely ready. We just have to wait for regulatory limits to open up.
Yeah. RBI limits.
Absolutely.
Sir, thank you for giving us a complete insight. I know you have a time constraint today.
Oh, thank you. Thank you. Nice talking to you.
Could have done it much better. Thank you for watching our podcast. And again, I am telling you that Mr. Aashish Somaiyaa, who has done phenomenally in Motilal as well as doing excellent in WhiteOak, I hope that WhiteOak will have a much thriving mutual fund space in coming years. Thank you, sir, for giving us a time from your busy schedule.
No, my pleasure. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.